Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's May 31st. I'm Frank Kurz, that's the Wall Street Unplugged podcast. So break the headlines and... tell you what's really moving these markets. Hopefully you're enjoying the start of the summer. It's weird since Memorial Day weekend in Jacksonville. Weather was a little mild. Usually in the 90s. I think it was in the 70s. Starting to heat up now. But my kids finished school, so they're home all day, which could be a little bit of a pain in the ass based on their ages. Depends. I love my kids. They're 12 and 15. My 15-year-old is about to get a permit, so she'll be driving next year. So it'll be a lot easier, right, when she's driving all around. She knows how to drive already. I taught her how to drive. My 12-year-old is awesome, right? She's like, Dad, you're going to work again. Can you stay home? Can you hang out all the time? So, she's at like the perfect age. She still wants to hang out with Dad and stuff. And, gotta love that age. 15-year-old, though, my daughter going through the hormonal stage. I hate you and I love you in the same sentence. Insanely moody, which I ignore. But my wife gets on her a little bit, which usually causes some blow-ups. I try to tell her, hey, it's just a phase. She doesn't really hate you. But, you go into freshman year, the insecurities, meeting new friends. I remember my freshman year. Holy cow. I think I had like 2 or 3 friends. Everything's just all over the place. Plus with social media these days, just looking at everyone who's hanging out, your friends, you think everybody's perfect. You're worried about your body. It's just, the insecurities is crazy. It's just such a tough age. So, I try to tell my wife just to relax a little bit and have fun. She's a really good kid, though, my 15-year-old. They're awesome, both of them. But they're home all the time. So, which puts a little extra pressure on mom to, show them a good time and drive them to their friend's house and stuff like that. But anyway, I hope all you enjoying the summer with your families, right? Have vacation plan. Hopefully you have time to relax, which is always tough these days. Everybody seems really, really busy. Unfortunately, I don't think it's going to be a good summer or a good year for stocks. In fact, over the next 12 to 18 months, we're likely to see a lot of pain. And when I look at the details I'm about to share, none of it is good. I'm trying to say that, there's a little bit of money on the sidelines for managers that they could put to work. Very few positives here. And I want you to hear me out on this because this podcast will be the most important one you listen to all year. And if we look back 6 months, I thought it would take place 6 months ago. And NASDAQ is up, 20% plus. It looks like we're in a bull market. However, we've seen so many sectors get nailed, right? We've seen small caps get destroyed, aggressive sectors where alternative energy, green energy, stocks, SPACs. Look at EVs outside of Tesla. A lot of banks got hurt recently through the bank crisis. But what's different now compared to 6 months ago? Because we have the NASDAQ and tech stocks mostly surging, but this is led by 5 companies, right? You have NVIDIA, Microsoft, Amazon, Google, Apple, which now represent over 25% of the overall market. If you take the top 10 stocks, they represent 33% of the entire market. That's the highest that we've ever seen, even dating back to the tech bubble. So if you take those 10 stocks that represent that, they're accounting for all the gains in the S&P 500 this year. So if you don't own those stocks, chances are you're not doing that good. But looking back, anticipating like these are going to be the areas that are like treasuries or a safe haven for money managers where they can get paid for investing in equities and investing that capital. And these companies, despite how good you think they're doing, their earnings are still down on average on 10% year over year, but their stocks are up tremendously. How often do you see that? How often do you see the NASDAQ go up 25% when earnings are down 10%? You almost never see it. Now, the NASDAQ at a 52-week high, some people say it's a positive, it's a new bull market. But you really have to look at the breadth, which is horrible. And it's actually at its widest gap in over 2 years when it comes to new lows hitting new highs. That's considered a very bearish sentiment indicator, especially from technicals. When you see something hit a new high or a market hit a new high, you would think most stocks are hitting new highs. Most stocks are hitting lows, not highs. It suggests just a few select companies are healthy and most are not. And we're seeing that through a lot of reports. So companies are beating. It's a lot of buybacks. They're not really raising their estimates too much. You're seeing, again, with the big tech companies with huge balance sheets and $70 billion, $90 billion buybacks from Apple and Google. And so that's great. A lot of money going into AI specifically, which is great for NVIDIA. But if you look at all the CapEx spending, which is hundreds of billions of dollars in this sector, what is it leading to? It's leading to almost no growth in earnings. At least they have cash positions because you could earn 4.5%, 5% on it, more than the amount of money you're paying for CapEx to grow your company. It's crazy. So they're in pretty good positions. We look at a positive where you can say the debt ceiling deal got done. Yay, it's awesome. Okay, we all knew it was going to be a deal, right? They weren't going to shut down the government. No surprise there. And now let's break it down. Assuming that doesn't, again, they're voting on it. You're going to see the far right and the far left argue. The middle, I think, are in agreement. But assuming they get the necessary votes. Let's cover a couple things here. Because people think this is a win-lose situation. And it's not. It's basically a lose-lose situation. Here's why. First, we're going to extend the debt limit. And it cuts almost nothing. They're going to tell you they're cutting 10 to 20 billion. They're going to rename this thing. Whatever they renamed it was kind of funny. I saw it. What they always do, our politicians. They just look at us like we're assholes. It's great. But we're going to see our debt inflate from 32 trillion, which is closing in right now, to over 35 trillion in 2025. Okay, so it's going to go higher. Now, here's some scary details since, again, most believe this is great news since we avoided a government shutdown. Once this is approved, the Treasury is going to need to scramble to replenish its cash buffer, which is empty, right? It's empty. That's to pay its obligations, right? Jenny will say, we're broke on the first of this, whatever they pushed out to, maybe another week or whatever. So this is going to happen through Treasury bill sales, which are estimated to be well over $1 trillion right out of the gate. $1 trillion. So what does this do? Who's going to buy these? It's banks, right? They're going to drain liquidity from the banking sector. So in other words, in short, for the Treasury to build up cash, you see a massive reduction in banking reserves, which will reduce liquidity, which results in a further tightening of credit. Now, it's a pretty big deal considering Bank of America came out and said, when the Treasury does this, there's a $1 trillion in bonds, it's considered that this short-term funding and this raise is similar to having a quarter-point interest rate hike. I love putting it in that perspective. I hate to throw numbers at you without putting perspective. That's what this is seen right out of the gate. And people aren't talking about that. Oh, we're fine. We're just going to raise it. Everything's cool. Well, to personally taking liquidity out of the market, which is what the Fed's trying to do anyway. That's less money to go to other things. Also including the debt deal, which is a major headwind. The suspension of payments on a $1.1 trillion in student loans. That's over. So you have these students are going to have to start paying this now. And I think it's 3 to 4 months, like starting in September, I believe. Now, why is that such a big deal? Well, during COVID, right, announced by the administration, the suspension of student loan payments, and this provided a massive boost to the economy. So if you're looking from March 20th to December 22nd, to December 2022, it boosted personal income by $2.3 trillion. This is according to a consulting firm that I respect, FreightWaves. The Fed estimates that the average student loan payment is close to $400 a month. Now that's going to kick in again. This is for 25 million Americans that have deferred payments for student debt. These are people in the 18 to 44-year-old demographic, one of the most important demographic groups that drive consumer spending. Now they're going to have to start paying these bills again, which is a lot of money. Again, something that's going to take money out of the system, less liquidity. People aren't talking about that. So while we got this deal done, you have to be careful. I mean, it's kind of like a lose-lose. You don't want the government to shut down, but just because we got this done doesn't mean, okay, we're fine, the government's going to spend money, everything's great. I'm also curious to see who buys this debt. And if you look at the last 3 years, you had what? The Fed, the banks, absorbing this debt, fell on them. But if you look at recently, raising rates due to quantitative tightening and things like that, they kind of withdrawn from that role a little bit. And then when you look at foreign investors coming in, they've been net purchase of U.S. Treasuries, right? Or have not been net purchase of U.S. Treasuries for a while now. I mean, if you look at the charts and how much that has gone down considerably, from like 40% to like 22, 23%. I have all the charts, again, did lots of data on this and research. And what are they buying? They're buying gold, which we'll get to in a minute. Massive gold buying again last month. Massive. I mean, we're talking about a half-century high in gold purchases from central banks outside the U.S. So it's going to be interesting to see how this goes once it gets approved and signed. And there's some really good economists that are talking numbers. Even Goldman talked about these numbers too, the two things I talked about. And it's going to result in a lot of money coming out of the system, less spending on discretionary things. And are we factoring that in? I don't know. So don't be surprised if we sell off right off the bat as we do get the decision and all the votes come in. I wouldn't be surprised. You're kind of seeing that now. We kind of peaked that day, and now it's selling off a little bit. If you look at earnings, which growing up 30 years, go back for 100 years, that's the main driver of stock prices, right? And growth. You want to see earnings and growth, but growth works like SPACs, but you have to have earnings behind it, or this is what happens to SPACs. You don't have the earnings growth behind it with these crazy valuations, right? So usually you have to have those earnings. Well, if you look at earnings this quarter, they came in a little bit better than expected. And that's thanks to a few companies in technology. They beat the estimates that was significantly lowered and also announced major buybacks. But they're still expected to decline sharply, earnings, over the next 2 quarters, year over year. Yet, if you're looking at the NASDAQ and how much it's up, again, when you look at tech earnings, they beat across the board. NVIDIA raised incredibly. I don't know if they saw the earnings number. I just saw, obviously, the revenue go from 11 to 14 billion. But even their projections are showing that earnings are down year over year by roughly 10%. Maybe it's 8% after earnings, but it's 10%. This is facts that I looked about 4 days ago for overall tech sector. So you're seeing the NASDAQ rise tremendously in the face of slower earnings, which I mentioned earlier. And if you look at the next 2 quarters, what are we going to see? Earnings expected to decline year over year the next 2 quarters. While we're trading well above the 10-year average on valuation at 18 times forward earnings for the S&P 500. And even much higher for tech companies. I think it's 33 times, or over 30 times earnings for tech companies. And these valuations are insane because we're taking a 10-year average, which included what? Free money by the government and super low interest rates, which we don't have anymore. So we look forward and people say, well, the market may crash. It's going to be hard for the overall market to crash when you have 33% represented by companies that have great balance sheets that everybody's pouring money into. It doesn't mean your portfolio can't go down 20, 30% unless you own some of these. But you're going to have to own some of them at sky-high valuations. So we could see tech hold up a little bit. And they're just so big, great balance sheets, earning 4% of their cash. That's what they can earn on the cash of their balance sheets, which is better than, that CapEx spending, hundreds of billions of dollars in CapEx spending going in, right? So you to grow your company. And you're not seeing that growth in earnings. Why don't you just hold the cash? Some of these companies are buying back their stock. Do you really want them to buy back? Do you want Apple and Google to buy back their stock right now? Maybe Google. It's not too expensive. But Apple at like 27, 28 times earnings. Do you want to see them buy back at this level? I mean, you're seeing slower growth across the board in so many different sectors for Apple. It wasn't the best quarter. Now you're seeing the big thing to flip phones. I don't know if you saw this. Major articles out how millennials are going to flip phones. They're not buying the more expensive phones now. There's a reason why. Apple never gave away their phones. I just switched to AT&T. They gave you away the free 14. I know 15 is coming out whenever, September. But they never did that before. They never gave away, if you switch, you get a free phone. Automatic upgrade. They never did that. They didn't have to do that. Okay, that's their bread and butter. You really want them buying back their stock here? No, but they have a lot of cash and can earn pretty good money on that cash, 4% plus, which is much higher than their earnings. So you may see them hold up a little bit, but when you look at the market as a whole, especially if we look at the debt, and we look at this time around, okay, I remember looking at watching videos from Doug Casey in the 80s. I was born in the early 70s. Even videos, just everybody was always worried about debt, right? And I always said this, and especially for the last 10 years, you have nothing to worry about debt. That's not an issue unless you stop paying it. Then it becomes an issue. Okay, and we never had that problem because we had 0% interest rates and money was free. So we never had that problem, even though debt levels went up and up and up. But here's why it's different this time around, the U.S. and globally. I know you hear that, and you're like, well, people say it's different 10 years ago, 20 years ago. Just hear the numbers, okay? And please pay attention, because I am going to throw some numbers at you, but I'm going to try to simplify it, because this is very important for you to understand. So when you have global debt, you can cure it in 2 ways. You can cut spending, which our idiot politicians will never, ever do, right? We know that. There's no accountability. They're going to spend as much as they can. Or you grow your way out of it. It's more revenue from taxes, capital gains, or whatever. So forget about, we just saw, We just raised the debt ceiling, right? We're not cutting spending at all. So how do we grow our way out of it? Well, let's see if we can do that. So we look at the conference board, someone I respect very much, and these estimates are kind of similar, but world growth, right? GDP growth is expected to slow 2.3% this year. Then forecasted to rise 2.5% in 2024. For developed nations, that's expected to slow 1.3%, much, much worse for developed nations. That's how slow it is. Again, world growth expected to grow just 2.3% this year and 2.5% next year. Let's put this in perspective. If we look since the credit crisis of 2010, world GDP has grown around 3.3% on average annually. So we're growing 3.3% on average annually. Zero rates. And during this time, global debt surged from $210 trillion to $305 trillion today. Again, this is with 3.3% growth annually. Even better, global debt was just $226 trillion in January 2021. So in January 2021, think about that time frame. What happened? You're like, well, COVID, we started reopening. A lot of places started reopening in 2021. Almost every single asset class hit an all-time high in January 2021. This includes real estate, stocks, collectibles, autos, almost everything across the board. Unemployment was strong. Everything was reopening. We were just like sky high. And our debt still increased from $226 trillion in January 2021 to $305 trillion, $75 trillion higher global debt. Even though we reopened. This is when the economy was strong and good. In 2021, great year, rebounded, all this money into the system. So how could we grow our way out of this debt? With world GDP expected to grow 20% slower than it did for the past 10 years. And you're looking at the numbers, we had close to $100 trillion in debt in 10 years at 3.3% growth and zero rates. But now, like I said, world GDP is expected to grow just 2.3% and 2.5% in 2024. And what are countries doing right now? They're still announcing stimulus plans, including us. Again, just increase our debt limit, which is going to go up at least $3 trillion in the next 3 years, at least. So I ask you this question, if you're bullish. Where's the growth going to come from? Where are we going to get growth from? Most European nations are in terrible shape. Some are slowing and still have inflation at 30-year highs like the UK. You see the core inflation for the UK? Last month's at 10%. Some are in recession like Germany. Italy, France are barely growing, expected to barely grow next year. They'll probably be in a recession pretty soon. Then we go to China. Remember the China story over the past couple of months? They're reopening. Everything's great in China and the BRICS nations and everything. China is now having COVID breakouts again. Almost every metric, even from today in PMI, but you look at manufacturing PMI, contracted worse than expected in April. Especially when you strip out the steel PMI, which is the ultimate gauge for manufacturing and growth in China, right? Steel. That slipped to 35. That's the lowest number. Forget about 35 is the lowest number since June 2022. How in the hell is that possible? Because in June 2022, again, last year, China was mostly closed. This number is worse than that. That's how bad it is in China right now. Home sales are slowing. Real estate developers are in a horrible, horrible, horrible condition. Look at the commodities index, copper, iron ore coming down as well. Clear indication that China is slowing. It's starting to crash, not just slow, but to crash. Outside of Macau, which gambling, people are going to gamble no matter what. I mean, if you're looking at the data that's coming out here, it's pretty scary. And you're seeing that, again, from the commodities index just starting to crash. Non-manufacturing. Let's talk about non-manufacturing, right? Fell to 54 from 56 last month. All you need to know is it's declining. How is it declining with China opening? And this is while construction also fell. So when you look at China, these figures are supposed to be getting better and better and better, not falling, which means what? China is going to have to provide more stimulus to help stimulate their economy and growth. So if you look at GDP estimates, and people say, well, GDP is growing, expected to grow 5%. That's what the estimates are, about 5.2% for 2023, and they've come down recently. Outside of 2020, let's put this in perspective, because 5% seems like a lot, but this is China. Okay, so if you look outside of 2020, which is COVID, the last time China grew its economy by less than 5% was over 30 years ago in 1990. If you're going under 6%, that's a recession for China. Probably under 6.5% is a recession. So China's in recession right now. So growth going to come from China? That's what we expected. Oh, they're reopening. Here we come. No. Are we going to see from Brazil, who's seeing mass deflation, unemployment's at 8.5%, while inflation's over 7%? And deflation. I mean, you're seeing deflation, stagflation. Russia's a non-factor, right now. India is in pretty good shape. 6% GDP growth, inflation easing from 6% to 8%, but unemployment is still very, very high, and India is just not big enough to move the needle for the rest of the world, like China. So again, I mean, I'm asking, where's the growth going to come from? And look at the research and just really digging in and going into the numbers. Again, I don't want to bore the shit out of you with numbers, but it's important that you understand this. If you listen to me for the past 20 years, 30 years, I'm an optimist. I'm mostly bullish on stocks. I always find opportunity for stocks. This is going to end in a disaster, and it's not going to be pretty. I mean, most of the countries have very high inflation rates, are sitting at record debt GDP ratios. So how much could the government stimulate these economies without causing inflation to run even higher? And that's these countries. Well, let's get back to the U.S. At $32 trillion in debt, our interest payments alone are over $1 trillion. Around $1 trillion. More than what we spend on defense spending. Also equal to what we pay, a little bit lower than Social Security. A better way to understand this is the overall interest payments now that rates have rose on this debt. So the overall interest payments on this debt alone accounts for 3% of GDP. Which is fascinating, right? Because most are forecasting a U.S. recession coming this year, or 2 straight quarters of negative GDP growth. But our debt payments account for 3% of GDP. Just the interest on our debt. Just the interest. That's how out of hand this is. Now, when you look at reports and you're seeing what's coming out, and, again, even the ones that NVIDIA, a one-off incredible quarter. But even some of the technology companies that reported decent earnings, Meta's starting to come back. Again, they're starting to see sales. They addressed a lot of their problems. But if you're looking just at the reports from what these companies are saying, I mean, no one's really significantly raising their estimates. I mean, you got to be crazy raising your estimates right now. But I don't know, you saw the report from Foot Locker. Advanced Auto Parts today lowered their, they cut the dividend and what was it, $10 a share they're expecting for the next year, for this year, whatever it was, and they lowered it to $6. And seeing margin compression. Most major retailers, if you listen to the call, they're warning consumers are cutting back. They're able to raise prices and do okay. And, especially, the Walmarts and McDonald's who are the lowest prices in their sectors. It's a lot easier for them to raise price a little bit and still be cheaper than everybody else. But they're warning. Loan loss reserves are going up at every single bank, meaning that not as many people are paying their bills. Harley-Davidson cannot hire enough people to repossess their motorcycles as people stop making payments. Credit card debt has now surged to a record over $1 trillion. $1 trillion, with the average interest rate at a record 25%. You know how many people have credit card debt? 25% interest. Are you out of your mind? If you look at the banks, they were supposed to be a driver of this market, right? Higher interest is supposed to be better for them. But now, if they're going to come out with new regulation, once that's passed, it's going to result in tighter credit standards. And you're going to see earnings come down because of that. That's why earnings are being lowered across the board of many of these banks. Outside of JP Morgan, who just got, a bank for free, which is awesome. You got to love that. Have you guys seen interest rates? Do you see what's happening? I think interest rates are coming down. It's a better market. Mortgage rates for 30-year just topped 8% this week. 8%. If you look at that, the 2 years surging, all interest rates surging. But specifically, if you look at mortgage, housing is one of the biggest drivers of economic growth. When you buy a house, think about everything that you buy inside of it. Believe me, I know this firsthand with all the money I'm spending right now, which is crazy. On new things, built a new house, it's just all the money that pours in, all the appliances, everything that you're doing. Major driver of economic growth. There are going to be much fewer people buying at this rate compared to when it was 3%, which is what, 18 months ago? You want to put that in perspective? The average home price is around $425,000 in America. So if you put 20% down and you take out a 3% 30-year mortgage, the payment is $1,400 a month. If you increase it to 8%, it's over $2,500 a month. $1,100 more. $13,000 extra a year just in payments right out of your pocket. You know how much money that is? when 60% of people living from paycheck to paycheck, you know how much $13,000 a year is to so many people who own homes? That's what you're going to have to pay, which does not include property taxes, which are being raised every year. Homeowners insurance, which is being raised every year. HOA fees, if you want to get someplace in nice areas or whatever. But rates are surging right now. Remember, what crashed the market in 2022, especially technology companies? Well, higher rates are going to hurt them the most. Well, we're at the highest levels here, guys. I mean, they were considered bad for big tech and growth stocks. Are they not no longer? I mean, these guys spend so much money, they can cut costs. They're going to be buying back their stock. You're going to see earnings, do okay for them. Probably hold up better, but they're probably still going to be down overall outside of NVIDIA, which everyone's buying the chips, 70% margins. Not going to maintain that. If you have 15% margins, people are going to come after you. Plus, you have all these big tech companies. I think you have Microsoft and you have Google launching their own chip divisions. I mean, it's 70% margins, and the amount of money that you're paying in billions to AI and programs. And I mean, this is a hardware company, basically, right? With software programs inside of it. But at 70% margins, everybody's going to be coming after them. They have to. They're going to maintain those. But anyway, they should do pretty good, right? They're one company that's going to be doing good earnings. But again, it's like a one-off. But now I guess higher rates aren't considered bad for these stocks. I mean, they're considered bad for many of the growth stocks. You've seen names across the board get annihilated outside of like the top 10 and pretty much maybe the large caps in most of the sectors. Some of the like top 3 large caps where you see more money go into the safer areas right now. Okay, not a good sign. But I guess higher rates are good. I don't know. Maybe that changed. Now, remember earlier this month, the Fed raised rates. And they had the pause. Everyone's going to pause. I mean, shortly after FOMC futures priced at a 91% chance of a pause at its June meeting. You know what it is right now? This is right now. There's a 70% chance they're going to hike when they meet in 2 weeks. How quickly that changed. Why? Because we're seeing inflation run hot. Even though we've seen deflationary indicators all over the place. Now, why is it such a discrepancy? Why aren't we seeing it all over the place? Because we injected $13 trillion into his system, $4.5 trillion after the markets are at record highs in 2021, and now it's almost impossible to get all this money out of the system. So it's inflating some areas while crushing other areas while we have tighter conditions. And it's all over the place, making it extremely difficult to predict where the economy is headed. If you're looking at unemployment, if you're looking at wage growth, you're like, wow, the economy's booming. If you're looking at a lot of other indicators, it's not. What I do know is inflation, the core inflation, is well over 5%. It's not even closer to 2% target. But this is something that the market is not seeing, in my opinion. This is the big disconnect. Because we've always had the Fed to bail us out time and time again. Right? If you had the credit crisis, they went all in. And we're going to look back 30 years from now and highlight the credit crisis as one of the biggest things that hurt the United States of America in terms of not losing our reserve currency status, but it's going to go down well below 50%, probably 40%, and other alternatives. Because the amount of spending that we did, the worst thing that happened during the credit crisis, guys, is that we needed to bail out the banks. Otherwise, nobody would have money. Unemployment went to 40%, 50%. Your money's in the banks. Everybody has money in the banks, and they had no money, right? So you had to bail them out. Whether you like it or not, I hated it, but you had to bail them out. I understand the government did. But the fact that they made money on everything that they bailed out meant that it was going to give them a pass to spend as much as they can whenever they want for the next crisis, which happened to be COVID. And to put that in perspective, they spent, $430 billion out of the $700 billion in TARP that was allocated to save the financial markets. And if you're looking at the U.S. alone, it's, $12 trillion that we spent on COVID alone. Just to inflate the markets when we shut everything down. And we didn't take the money out of the market when we reopened. And we reopened pretty quickly. Within 4 to 6 months, pretty much everything started to open again. More and more and more. But it gave the Fed the right to say, hey, you know what? And our politicians, just spend as much money as you can. Nobody cares. Nobody's keeping balances, whatever. Throw trillions in climate change, throw trillions at everything, anything that you want to do, and that's fine. And there's consequences to doing this. As someone who never really cared about the debt because we're always able to pay it off, it's not going to be that easy going forward. So now, why is it different this time? Because the Fed's not going to be there to bail us out again. They can't, because they have inflation that's very, very high. So when you have core inflation well over 5%, they still have to bring that down because that gives them power. They don't care about forcing recession. Yes, things are going to break. They have no power unless they bring it down. You can say, well, they do have power. They could increase, whatever, but it's going to result in much, much higher inflation. And you can't get, as we saw, and they made the biggest mistake in the last 30, 40 years in Fed policy, saying that inflation is going to be transitory, so much so that you will buy mortgage-backed securities right into it, saying, oh, we're going to be fine, we're fine, and stimulating the market. And now you raise rates by the fastest pace in the Fed era, by 1,900%. And you're going to raise again in 2 weeks, most likely. Again, that creates tighter conditions. But with this debt and with inflation running wild, it limits the Fed ability to stimulate the economy if things get worse. And they were always there to stimulate the economy. They're not anymore. So when I look at technicals, fundamentals, earnings, economic growth, it's hard to find catalysts that are going to drive equities higher. They could go higher. They can go higher for another year. We saw that in 1999 when equities doubled, when they were overvalued. We go from NASDAQ 2,500 to over 5,000. I think it might have hit 6,000. And it crashed to below 1,000, right? 1,200, whatever it was, in 2020 and 2022. Just went down for 3 straight years. So it was overvalued for most of 1999, but you could see it go a little bit higher. But right now, with everything going, it seems like we're at that point. I mean, how much more money could go into these 10 stocks? I said I covered 13 Fs for decades. I've never seen this much money from money managers go into those big stocks. I mean, they're over-owned. How much more money can go into them? I don't know. But you're seeing a decline in a lot of stocks. Why are you seeing so many hit 52-week lows? And the breadth is so terrible. But it's hard to find a catalyst, not to mention, especially when you can make, 4.5% risk-free and go to sleep at night. 4.5% in savings accounts. Many savings accounts, including Apple's new savings account. 4.5% you can make. Go to sleep and wake up, hey, I'm okay at 4.5%. That's great. And say you're going to be buying tech companies trading at 30 times earnings that aren't growing earnings, right? 30 times future earnings that are barely growing. They're declining year over year. And 4.5% sounds pretty cool right now. With that said, you need to start positioning yourself to benefit. And how could you do that? Buy gold and buy Bitcoin. Central banks are loading up on gold. Biggest buying in a half century. It's happened all last year. People thought it was going to tail off. It's happening even more. Bitcoin, Ethereum are going to be extremely powerful alternatives to central banks printing an unlimited amount of debt, which, again, China just said we're going to print more money. We just raised the debt ceiling. Everybody's going to be printing money until you can't. Because these debt levels are getting out of control. And they're printing money while most of their economies are still experiencing inflation. Good luck with that. Now, this may sound crazy. Start looking at small caps. Tell you the market's going to come down. The worst. Listen, the NASDAQ 100 compared to the Russell 2000. Okay, when you take these two and compare the performance of them, they just retested its peak of the tech bubble in 2000. It's the widest discrepancy that we've ever seen between these two asset classes. And it usually results in small caps significantly outperforming. In short, if you're looking at it, it's the price people are paying, which is 30 times projected growth for large cap tech, with their expectations that fundamentals are going to improve just significantly from here, which is not really going to happen. I don't see it. But when you look at small caps, expectations are zero. When many of these names are already down, 70-80% have got annihilated. Now, I say this a lot, but I've been doing this for 3 decades. And there are times to go all in, there's times to be in the sideline. For me, my biggest wins and biggest gains, they don't come from buying stocks in bull markets. You get nice percentages that way. It comes from when you're seeing massive disconnects, which only happen when you have markets like this that are crazy, when no one knows what's going on. And we really did a great job during COVID. We sold out of many of our stocks. And 2 months later, 3 months later, we really got in and had exceptional gains. And we even provided some research reports saying these are the companies, once this thing bounces back. I didn't know it bounced back that quick. I didn't think the government was going to throw trillions and trillions and trillions into the economy right away. Nobody saw that coming, but we timed it pretty well and did well with a lot of stocks. But the biggest gains come when you see those disconnects. Even the biggest trades in the world. If you look at Ackman, if you look at Soros, you look at just managers, top managers in the world, they'll always, it's when you have these disconnects is when they make the most money. The disconnected small caps, I don't think I've ever seen it this big compared to the rest of the market. With biotech names are trading below net cash. SPACs are down 90% plus, which came out at shitty valuations and crushed everyone while insiders got out. Biggest scam in the world. But SPACs, many of these companies, they're still good companies. They're growing earnings and sales much, much faster than the overall market. They have no debt, and they're sitting on massive cash hoards. They're in great position. People are going to hate them because a lot were in the Coinbase is at 400. Space stocks, they were 90% higher. They're going out of business now. But I'm seeing tons of ideas in this space which have much of the risk I mentioned during the podcast are priced in because they're down so much. It might not be 3 months, 6 months, but the next 12 months and going forward, holding these things for the next 3-4 years, and you're going to see exceptional gains in many of these names because they're down so much. Plus, they see the risk coming. They already cut costs. They're just down tremendously compared to a lot of large caps, which get mentioned on CNBC on TV all day. Lastly, learn how to buy puts. We talked about this in Money Flow Trader newsletter, and look, the performance has sucked over the past 6 months because, for the Nasdaq at least, the Nasdaq's up 20% plus. But this is not a newsletter just best against tech companies. There's many names and sectors that are starting to crash now, and starting to crash, but you see names fall 20, 30% when they miss because expectations are still high. And this newsletter can make you an absolute fortune if the market or a stock recommendation falls just 15, 20%. If you think it's going to happen over a 12-month period, pretty much in the early stages of that 12-month period, maybe the first 4 months. Since Jenny Terminal runs this product, she's an expert. She's buying long-dated puts. So this news is about putting 3 to 5% of your portfolio into buy puts where the most you could lose is the money you put in. That's it. But many times, even if those bearish bets don't work, you lose 3% of your portfolio, 5% of your portfolio, but the chance of the rest of your portfolio is probably going to make up the difference and do pretty well, which has happened. In our newsletters, where we have a put or two, we lost our money in our put, but, performance been keeping up with the overall markets. But when it does work, guys, this isn't like insurance. This isn't like hedging, right? And protecting yourself. I mean, it's protecting yourself. But Jenny has logged over 500% gains on one position in 2 months. And this is during COVID. A bunch of 200% gains in a few months. When the market has come down, even in 2022, lots of triple-digit winners. I mean, when you see the portfolio, you'll see losses because right away it's time value and losses and stuff like that. But if you hit a banking stock that collapses, and collapses like some of the ones that we saw, the 5% of your portfolio could be worth more than the other 95%. That's why it's worth it. And with this many risks in the marketplace, you need this. Okay, I'm not a guy shouting from the rooftops going, "Holy shit, get the hell out of here, I got to crash." I didn't sell everything out of all of our portfolios this time around like I did in COVID. But you have to be cautious here because there is more risk in this marketplace than I've seen. And I can't remember another time when I saw it like this, where the out-of-control spending, the amount of interest, where rates are, and how we're still seeing stocks and valuations in some areas. It's really crazy. There's just a lack of growth catalysts to be trading at this expensive valuation. And most importantly, you do not have that Fed put in there, which is going to be there all the time for the last 10 years. Low interest rates, free money no matter what, debt easy to pay. It's a lot different now. It's a lot different now. So there's many risks in the marketplace. Guys, this is important. Learn this strategy. Learn it. And Jenny with our Money Flow Trades says exactly what to do. Potential upside each trade. Shows you how to buy these things for your online brokerage account. It's very easy to do. It's not hard at all. Again, it's not shorting the market where you have unlimited downside. And if you short the market, say if you short NVIDIA, I thought NVIDIA was going to come down. I didn't think it would go after running up tremendously, 100+% into the quarter. That it was trading at 300, which was higher than the average target price of all the 40 analysts covering the stock, which I think 80% had buy ratings, 75% had buy ratings on it. And you go, no way. No way. And it went up and it surged, right? But if that would happen, you get annihilated if you short. If not, you lose the money you put in the put. Whatever that is. It could be $300, $500, $1,000, whatever. So you know your full risk going in. Now, we have 3 newsletters at Curzon Research that are called back-end services, right, that fall into these areas that I think offer tremendous value for investors. Okay, you've never heard me pitch these companies and talk about them at the same time. But we have Money Flow Trader, which I mentioned, Crypto Intelligence, which is on cryptos, and Curzon Venture Opportunities, which is our flagship newsletter. I sold these products for as much as $5,000 annually. I discounted them to $3,000 annually, sometimes maybe a little bit less on special deals. But that's only for like 2-3 years that people come in. In the coming weeks, I'm going to discount these newsletters significantly. It's going to be a one-time only thing. So if you currently have these services, you could add another year to it. And you might be asking, why would I discount premium newsletters so much? Okay, marketing or email, you never want to discount products and stuff like that. The reason why I'm doing it, because any of you buying these newsletters today, you'll likely become a client of mine for the next 10 to 20 years. That's the opportunity I see in front of me right now for these 3 newsletters, all 3 of them, to be positioned in them. Because when you look at businesses and analyze them for decades and decades and decades, the ones that survive are the ones that take care of their customers. It's been a tough market, lots of confusion. You need someone you could trust going to be there during these times, someone that writes their own stuff. And, again, I'm doing a podcast for you. It's a difficult market. I love this shit. You could tell by all the numbers I threw at you. I usually keep this for my premium podcast, but I just wanted to share a lot of the data, the stuff that this is what I'm doing. This is like my hobby. I love doing this, right? So just looking at the numbers and trying to figure out ways of how I could be wrong on this or how I could be right on this. And the more I analyze this data, the more I look at it, these 3 newsletters are set up perfectly for this. Now, make no mistake, with this offer, these newsletters are not even come close to what we're going to be selling for a year from now. But I'm going to put together a special offer since I want you in these areas of the market. The timing is very good for small caps, for crypto, where Bitcoin and Ethereum survived the past 18 months of carnage, to where Coinbase is solid. They're not leaving the U.S. Fidelity's going to continue out trading cryptos. But if you look at the technology coming out of this sector right now, it's incredible. Not to mention demand. With so far in 2023, the amount of Bitcoin addresses with more than $10 increased by 16%, more than $100 increased by 23%, and over $1,000 have increased by 32%. You're seeing more and more people go into crypto because of what's happening, especially from central banks. And they might be thinking, well, it's crypto and it's shitty. For investors looking to speculate. If you're a speculative investor, which everyone should speculate with a small portion of your money, at least, even if you're 95 years old, that portion should be much, much smaller compared to someone who's maybe 30 years old. But you should always speculate with the chance of hitting a grand slam. And if you like to speculate, there is no sector in the world that offers a better risk return than crypto. Especially now that a lot of the garbage is out of the market. And we saw one of the worst conditions, bankrupt companies, a lot of the garbage leave. But when in 2021, our portfolio, the average position in our portfolio, we're not talking about 3 stocks, probably 12, 15. The average position was up over 600%, the average position. I've never seen that in anything, right? 2022 was a nightmare. We took lots of losses. 2022 was bad. It was horrible. Lots of bankruptcies. But from a risk-reward perspective, you can never get close to those returns by investing in stocks. Unless you're getting founder shares, which you have to be an accredited investor, right? Unless you're getting into SPACs and you're getting in at 50 cents, and then when these things crash from 10 to 7, you're still getting out with massive profits while everyone's getting murdered. The average investor is getting murdered. Crypto also gives you a chance to invest in AI at the early stages. There's a lot of great companies in there doing AI, and the utility features are amazing, where you can create your own AI programs and generate money through their crypto. That's about the utilities crypto, right? NFTs are starting to do well again. You're seeing much more applications for them. But make no mistake with crypto, it's the future. It makes sense given the current landscape when nobody trusts central governments. Not to mention, every central bank outside the U.S. is now launching their own central bank digital currency. Can't hate it that much. The next 2 years, I think we're going to see incredible gains in this sector. And it's going to come from the best names, which are down 80% plus from their highs. They got annihilated. And we had some moves higher in 2023. Bitcoin was up 4 straight months to start the year. I think they fell last month, which is this month in May. But even if you look at 2021, through all the garbage, Solana's still up 1,000%. Avalanche is great. Crypto up 300%. Ethereum's up over 150%. But this is a sector where I personally made more money than almost anything else I've ever invested in my life. And that's personally. It is risky. I'm not going to sugarcoat the risk. I never did. I did take losses. But for me, those gains exceed those losses by 13 to 1, getting in at the right time over the last 4 years. Some people came in a year ago, unfortunately. Some people came in 2 years ago, which isn't too bad. If you came in 3 years ago, you're still, doing well, and we're still up, a lot in some of these positions, on the early positions. But right now, where the best names in this space who are survivors are going to be around, think about the tech bubble. Same thing. Those survivors, and look where they were years later. This offers you an opportunity against some of the greatest technology. It's not going anywhere in the U.S. You're going to see more regulation around it probably over the next year or so. Again, Coinbase's not leaving the U.S. Fidelity's still offering them. You got Robinhood offering them. It's very easy to get in and out. But this is an area that's worth investing in for speculation, especially since it's down so much. And as for Curzio Venture, again, that is I love that product because, sometimes I'm modeling out and these companies are so small that people are looking at them going, using my models sometimes. So, it requires a lot of research when you're investing in very small stocks because the large caps have tons of coverage and you can get that anywhere and get opinions. But small caps, you really have to dig in and talk to management teams. So I love this part. Gold and silver, guys. I mean, you're going to see, especially in gold, gold's going to surge from these levels. It's inevitable based on the amount of buying, based on what's going on with central governments. Most junior miners and mining companies are complete shit. They're run terribly. Maybe from, mining these actual projects, they might be okay with geologists and stuff like that. But when it comes to the financing, dilution, warrants, options, look, they don't generate money, right? So they have to raise money. But it's just, there's so much dilution in these things. It's terrible. But for me, I have over 15 years of experience in this industry. I travel to Vancouver 3 times a year, spoke at major mining events. I met with, billionaires, learned from the best, like Marin Caduceus, Jeff Phillips, Rick Rule, and made tons of mistakes where I love companies and I recommended them and people did a financing in my face. Okay. You go through that trial and error and all that bullshit, which, you think crypto's bad. Mining, those scumbags know exactly what they're doing. In crypto, some of these kids really might not know as much, that they're really crushing you and thinking they have a good idea. These guys know that they're effing you right off the start, right? They know it. So you really need to understand that industry because most of those companies are run terribly. They run terribly. There's a reason why. If you look at every commodity, if oil goes higher, you see oil stocks at all-time highs. You see, go much higher. If you get natural gas, uranium surges, you see that. Gold's near its all-time high. And why do you think junior miners and a lot of these stocks are still 20, 30, 40% off their lows? It's because of how terrible and how much dilution is some of these companies. So you really have to know what you're doing. So I avoided gold stocks for most of the part. I recommend a few here and there. Took some losses here and there, a few exceptions. But you're going to see a lot more mining names going to CVO, and probably we're going to get into a lot of private placement deals if you're an accredited investor. One name we just interviewed, its co-founder and chair, is called US Gold. So I'm giving that away. It's in a portfolio. The interview is only available to CVO subscribers and Wall Street Unplugged Premium members. That's our new podcast, with Daniel and I did tomorrow, every Thursday. When you listen to it, and this is what Luke Norman, co-founder and chair, you're going to see the difference between a well-run junior miner and one that's crap. In fact, this may have been one of the best interviews I did in the gold space because of the education behind how he's de-risking a project and lowering the expenses on it and preparing for a stock that's going to be leaner than ever as gold prices go higher, and how they're going to bring this production at a much lower cost than everyone expects. These guys are positioning US Gold to go up 5 to 10x here when gold does go higher, which I think is going to go significantly higher from here over the next 2 years, which is why we have in our CVO portfolio. But these are the interviews and these are the things I'm going to have available for you with these newsletters. So it's a lot to digest here. Daniel, I'm going to break down a lot more details tomorrow on Wall Street Unplugged Premium. But to learn more about our new premium podcast, you can just go to wsuoffer.com. And anyone looking to subscribe to any of those back-end high-priced newsletters, they're all very high-priced. We are going to have discounts, just one-time discounts. You'll see this offer in a few weeks. It's only going to be available to our Wall Street Unplugged audience, right? So our most loyal followers. And I'm doing this for customers because coming in at these levels, I think you're going to be customers of mine and be listening to me. Maybe that's unfortunately for the next 20 years or so. But the opportunities I see in those 3 spaces are incredible, are really, really incredible where the markets are right now. And that's what we're focused on. That's how we're going to get through this, because there is some pain ahead, but you have to position yourself and be smart here. Guys, questions or comments? I'm here for you. That's it for me. I'll see you guys tomorrow. Take care.